Hello, everybody. I hope you are doing well. Thank you for attending, and we are going to be kicking off momentarily. It is 7 o'clock. It's an absolutely beautiful day here in San Antonio, Texas. And if you have not met me before, my name is Raza Khan. I am the Chief Investment Officer at Qila Capital. Qila is an ancient word in multiple Eastern languages, which means fortification or fortress. And our aim and our goal is to protect, capital like a fortress. So thank you for joining us. We're going to be kicking off momentarily. We're waiting for people to kind of come on in, and we're going to be kicking off. Today's agenda is a very interesting topic by popular demand. It's something that hospitality is often compared to. It's called, today's topic is called Beyond Multifamily, why the best and the smartest investors invest in hospitality in 2025, and why it is the best sector to be in as an investor. So I will be um, starting momentarily, and thank you for joining. I'm gonna put myself, turn the camera off, and we're gonna wait 2 minutes until everybody starts trickling in, and then we'll kick it off. Thank you. Okay, hello one more time. Raza Khan here from Qila Capital. And today's topic for the webinar is investing beyond multifamily, how hospitality beats multifamily investments in 2025 in every single way. So this is a topic that we've gotten a lot of feedback and requests for. And this is something I love to talk about. So today is going to be a little bit less about the opportunity, more so about the macroeconomic picture on why hospitality is the better choice in 2025. Okay. So to kick things off, I am going to be sharing my screen momentarily. Okay. Lovely. Hope everyone can see the screen. And with that said, we're going to kick it off. Thank you once again for joining. So first and foremost, the disclaimer, it was something that our compliance team absolutely makes us do. So we are a company that offers securities under the 506C Reg D, Regulation D, which means that only accredited investors are allowed to participate in the investment. And we are not financial advisors. We are not giving you financial advice. Everything that I'm discussing today is my own opinion. Okay. So the agenda is very straightforward. We're going to try to wrap this up within the next 30 minutes, hopefully sooner. And we're going to talk about the CRE trends. We're going to talk about what's happening in the world of commercial real estate at the moment. We're going to talk about the multifamily mediocrity. This is what I call it as an asset class. And then lastly, we're going to talk about the Aloft Hotel acquisition, which is our current offering that we are promoting. So first and foremost, welcome to Qila. Qila, our motto is that we are the fortress for wealth preservation for our investors. We're a commercial real estate investment company based out of San Antonio, Texas, and we specialize in bringing high potential opportunities in two asset classes, two sectors: healthcare and hospitality. We believe these are the best asset classes and the best sectors to be in. They're recession-proof, and that's why we're here talking about it with you. So You already know us. I mean, you may have seen emails from us, and I don't want to talk too much about us. I want to talk more about the opportunity. So, again, this is just a generic slide about what our mission is. Our mission is to safeguard your life's work and protect your capital like it's our own. And so again, let's just jump right into the meat and potatoes of the discussion. So, what are some of the CRE trends, the commercial real estate trends in 2025? So, just like residential real estate, I mean, a lot of us that are here today, we're actively participating in investments in one way or another, whether you're participating in the stock market or you own single family housing, short-term housing, or if you're an investor in other syndications. You may know and you may notice that we are still kind of coming out of a pandemic hangover. So, what do I mean by that? I mean that we're coming out of a black swan event that is abnormal, does not happen very often. There were a lot of anomalies that happened during COVID. One of them was obviously there was a massive injection of capital in the economy. The Federal Reserve printed, I don't know how many trillions of dollars, but a significant chunk of change, significant amount of money was injected into the economy. And obviously, that led to inflation. That led to asset prices going up. And they did that, obviously, quantitative easing, from the fiscal policy point of view and monetary policy. They had a lot of loan programs that people could borrow, et cetera. And of course, the interest rates were dropped significantly and making it very easy for investors to access capital. Okay. So, while that was the case, now obviously in 2025, the rates have gone up significantly. Um, a lot of people that had borrowed money using non-recourse loans, a lot of investors and asset owners that are invested in different types of commercial real estate like office, multifamily, industrial, hospitality, they borrowed money at very low rates and now those 5-year loans are becoming due and the rates are not what they were when they borrowed the money. The asset prices were inflated, the rates were very low. It was very affordable for them to just take out non-recourse loans without any personal guarantees and use that money to buy more real estate and multiply that their portfolio. Now it's time for a little belt tightening. So rates have climbed significantly, 7.5, 8% commercial mortgage rates right now. Asset prices have come down. So a lot of these asset owners are tightening their belt and lowering their cost of debt service and their loan payments. So what that means now is it's a weird situation. While the asset prices are gradually coming down and the rates are really high, it's hard for people to borrow money. Yet the economy is still booming somehow. The S&P just hit an all-time high again recently. And there's a new president in the White House. There's a new administration that is very pro-business, and they've brought in some new policies like the One Big Beautiful Bill, which is something that that's the benchmark or the landmark policy that they've introduced, tax bill. And they're also very big in the job creation. As you know, they're talking about bringing more jobs to the US. They're forcing companies to invest a lot of money back in the country and foreign companies. And with the use of tariffs, they're forcing people to create jobs in the US by investing in the US. So the new data suggests that finally, like this week, the new data that has come actually last week, the new data that has come out has shown that inflation is finally, um, inflation has obviously gone, it's things have gotten more expensive. Inflation has gone up and the job market is cooling slightly this quarter, which in a weird way may be the relief that we're looking for because the Federal Reserve is not going to lower rates unless they deem that it's necessary, that they need to boost the economy. So I think we need to slow down the economy in order for the Fed to lower the rates, which is going to be great for the commercial real estate market. Okay, moving on. This is a very interesting chart that I saw, graph that I saw. It's the CMBS delinquency data. So this shows us what the trends are like right now in different commercial real estate asset classes for non-recourse loans. So as you can see, overall, the delinquency rates are trending up in some asset classes. In some asset classes, they are not trending up. Hospitality is, it's unique, as you can see that it's listed as lodging here. So hospitality is trending down, interestingly enough. Office is the worst one, of course. It's just trending up continuously, going up, 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 up. And some of these other asset classes, they're here as well. Multifamily is also trending up, even though the rates are lower, the delinquency rates are lower in multifamily, but it is trending up. So we'll talk about, again, this is just a macroeconomic view. I'm not an economist. This is whatever I'm discussing are my observations and my thesis for why hospitality is the best asset class. Let's talk about why hospitality beats multifamily in 2025. Leisure and pleasure, okay, that is business leisure, remains strong. So there's an interesting trend right now that because work from home is still a thing and a lot of people are working from home, that gives people a lot of flexibility to travel and work while they travel, which is interesting. So travel demand continues to go up. Select extended stay and select service hotels are outperforming full service. Now, this is something that is also very interesting. I read an article recently. If we can have a quick little poll based on your opinion, what do you think is the most profitable brand for Hilton? I'll give you 2 seconds or 3 seconds to think about that for a second. So Hilton has a lot of different brands that you may know. Hilton, the Conrad, the Waldorf Astoria. These are the luxury brands. The answer to that question is the Hampton Inn, which is an extended stay hotel. So extended stay hotels outperform full service hotels because they're leaner to operate. There's no full service, food and beverage cost requirements, etc. So very fascinating, metric, so to speak. Thirdly, institutional capital is flowing in. So in 2024, institutional capital, Wall Street, their take in hospitality assets grew 14% year over year. That's also interesting because they've definitely gone into multifamily. We know that. We know, sadly, that America is becoming a renter nation and the American dream of home ownership is gradually shrinking. Hopefully, it'll come back one day. But large part of that is because Wall Street started buying single family and multifamily housing. Now they're also going into hotels and hospitality. Lastly, hospitality generally sees higher cap rates. Okay. What does that mean? A cap rate is a capitalization rate, which is the net operating income, which is the earnings, the net profit of an asset in commercial real estate divided by the value. Okay. So what that means is hotels generally deliver a higher yield than multifamily. Why is that? It's very obvious. Hotels are a hybrid between a business and real estate. They're underwritten like real estate, but they require some entrepreneurial spirit in the owner or the manager because it's like a business. It is a business. You have front desk staff, you have cleaning crews, and you have the laundry staff. You have sometimes there's a bartender, sometimes there's a shuttle driver, maintenance, all that stuff. It's operated like a hotel or like a business because it's short-term stay rather than long-term stays. Okay, so hospitality sees higher cap rates. Now, what is, moving on to what makes us unique and why we're here today. So we are a company that specializes in this asset class. We love hospitality, we love hotels, and we also love healthcare. And, that's why we're here today. So we have a proven track record. We have a proven strategy that seems to work. We have 3 hotels that are under management right now. And they're doing so well that we wanted to bring this opportunity to other investors. Okay. So, you know what? I apologize. I skipped a slide. This slide should have been before that one. So, why is hospitality the best investment in 2025? Cash flow, appreciation, recession, resilience, and lifestyle benefits. Now, this is definitely something you don't see with multifamily. So, cash flow. Hotels generate cash flow from day one. They are businesses that are operating. Okay. Especially with our strategy. There's no empty promises, risky construction or development. We're not land bankers that are buying land and raising money to build hotels on there. We are acquiring existing properties, existing hotels, generally under 30 to 40%, 30 to 40% below replacement cost. That's our criteria. And uh, a within a specific revenue multiple. Okay. So we'll talk about the Aloft in a moment, and you'll see what I mean by that. So for accredited investors, it's an opportunity beyond mediocre multifamily. Now the purpose of this presentation is not to, talk negatively about other people, other competitors, other fund managers that are out there. The reason why we're here is to we want to show you what other people do because they're our industry peers. However, the value for investors in that asset class in the multifamily asset class is not as high as hospitality for multiple reasons. Number one, in a lot of other fund managers out there that are promoting opportunities, generally they have backloaded IRRs, internal rate of returns. So your true profit is based on assumptions that we're going to build something or we're going to renovate something and raise the rents and then give you a profit. Generally speaking, because the cap rates are so low in multifamily, you don't really see returns, healthy returns from day one. You don't see cash flow from day one like you would in something like this. Okay. Number two, appreciation. So in commercial real estate, the asset value is tied to the net operating income. As you bump up the net operating income, the asset value also rises. So with hotels, it's all in our control. It's like buying a business, a small business, and turning it around, exactly what private equity does. We're not reinventing the wheel here. We're buying hotels, we're running them more efficiently, we're managing them better, we're lowering the cost and increasing the revenue. And when the profit goes up, the bottom line goes up, so does the value. Okay. Number three, recession resilience. Data shows that extended stay hotels have performed tremendously in the last 5 years. Even through the pandemic, they've performed great because if leisure demand goes down, other types of demand may go up. And that was a trend that we observed during COVID when our hotel portfolio was very busy, the occupancy was very high, and they were still making money while offices were shut down and a lot of other asset classes, types of real estate were shut down. So recession resilience. Our hotels currently, they have contracts with the DoD, which is now previously called the Department of Defense. As of last week, it's called the Department of War, DOW. So we have, and that's the same strategy that we try to employ, bring in corporate contracts, market the property right. So the guests come in and, corporate guests come in and single individual guests also come in and they keep coming back. And last but not least, the greatest benefit for why hospitality beats multifamily as an investment for accredited investors in 2025 is the lifestyle benefits. What does that mean? That means you get hotel owner discounts, you get ownership privileges, you get a preferred rate when you travel to any Marriott property around the world, Bonvoy property. There's over 10,000 Bonvoy properties under the Marriott Bonvoy umbrella. Okay, that's what makes it absolutely fantastic. It makes it the best lifestyle investment, and while delivering amazing returns. Moving on. What does our team look like? We have our CEO, Kuldeep Giani. We have Dr. Pareen Shah, and then myself. There are three partners. Between the three of us, we bring over 50 years, probably even more, in experience in real estate acquisition, finance, fund management, investor relations, and making us the ideal team to be your partner in wealth creation. Okay. I can send you this deck and you can review the individual profiles of who we are, etc. Our portfolio currently has multiple properties, healthcare properties, and hospitality properties, along with some other asset classes as well, which are not really mentioned that much. In combined, we have over $100 million in assets under management. In our careers, we've done over $250 million in transaction volume. And our target geography is South Texas. So this is an area that not a lot of people are experts in, but we love South Texas because this is an often neglected geography. But if the right opportunity comes up, we do and we will extend ourselves to the Texas Triangle, Austin, Dallas, Houston. But primarily, we're closer to the Austin area, located in San Antonio and further south. Our current portfolio, again, don't want to get too much into the details here because we're running short on time, but we have the Laredo Emergency Room, which is currently appraised at $47 million in value. We have the Staybridge Hotel, which is under the IHG brand. Current market value, $25 million. We have a Courtyard by Marriott in San Antonio, current value, $12 million. And some other assets as well. There's an extended stay hotel, which is being converted into a Hyatt Suites, one of the first in the US. We have the McAllen Emergency Room. We have a multifamily holdings in Laredo. And then we have some other, properties and other assets under the portfolio. Let's talk about the opportunity that we're here to talk about. And I will be hosting another webinar on Saturday, which is going to be all about the opportunity. It's not going to be the macro topic like today, but it's going to be the focused micro topic. So the opportunity, currently we are raising money for a new acquisition in San Antonio, Texas. It's the Aloft brand, Aloft by Marriott in San Antonio. It's located at the San Antonio airport. It's a 6-minute drive from the San Antonio airport. And we're raising a total of $16,135,000. And we're doing this at 100% equity. We're not raising any debt, any bank financing whatsoever. We're doing this 100% using cash because of everything I talked about. Now's not the ideal time. And we wanted to bring a risk-averse product to the market where investors can feel comfortable that we're not using any leverage. We're not playing around with bridge loans and bank financing. We're doing this as a very low risk conservative strategy. Total acquisition price is $10.5 million. The property improvement plan is $4.5 million, which is the planned upgrades for the hotel. Operational reserve, $750,000. Legals and closing costs and franchise fee, as stated, total is $16.135 million. And this is the location, which we'll talk about more on Saturday. And if you like, you can always book a call with me to dive deep. San Antonio is an interesting market because people don't realize, but it's the 7th largest city in the US, and it's the largest military city in the country. So there are 5 major bases, and 3 of them combined is known as the Joint Base San Antonio. And it is a major hub for the military, for the Department of War, okay, after the Pentagon. So a lot of demand in that regard. In terms of the actual investment, we have 2 different options for people to invest in. So number 1 is the growth fund, which is a 5-year holding period. And then the second option is a 2-year income note. Both are equity products. This is not registered as a debt on the property, but it is still a part of the equity fund. But it's just another flexible option for people to invest in that don't want to tie up their money for 5 years. The difference between the two is that the growth fund gives you preferred distributions plus profit sharing at any liquidity event, whether it's a sale or a refinance at the end of year 5. Total IRR is about 13% if you invest under $500,000. If you invest more than $500,000, it's 17%. The income note is the second option, which is a 10% coupon payment paid on a quarterly basis. And the other, the growth fund has the 8% or 10% preferred distribution, which is also paid on a quarterly basis. The best part is that our investors get a discount on any ticket over $100,000 at any of the 10,000 properties, Bonvoy properties around the world. And I'm just going to touch on this for a couple of minutes, but this is a very interesting little benefit of investing with us, that you get significant discounts when you travel. So this is a property, the Ritz-Carlton Laguna Niguel in California, Laguna Beach. And it's a beautiful property if you haven't been, absolutely beautiful, overlooking the Pacific Ocean. And it's a highly desirable luxury property. Same day, same room, as you can see, 1172 a night versus 281 a night, which is absolutely phenomenal. Great discounts. Again, another example of in New York, Times Square, same dates, 453 versus 257 a night. And then this is the London Marriott, 542 pounds versus 135 pounds. Fantastic benefit for those that travel frequently. Now, everything is done through a 506C Reg D offering, and which means that it's for accredited investors only. And that is somebody that has at least $200,000 in individual income or $300,000 household income, or a net worth of $1 million, not including your primary residence. And it's very simple. You can invest as cash, or you can invest with your IRA or 401k, which was just recently passed by the Trump administration. Everything is self-directed. We send you the information. We send you an invite to our portal, and you participate in the investment directly through the portal. Everything is very automated and very easy. And at this point, I am going to stop sharing my screen. If you have any questions, please let me know. And if you don't have any questions, then no problem. I will see you on Saturday. Any questions? Okay, I see a question that is asked here, and the gentleman is asking me, let me read this out. Is there a cap on the benefits? I don't know exactly what you mean by that, but I'm guessing that you're asking about the discount and whether if it's allowed to use it multiple times. Yes, it's unlimited. You can use it as many times as you like, and you can go to, there's a concierge, a dedicated, sorry, a dedicated email address that you can reach out to, and you just ask for a letter, and we issue the letter. And then when you go to the property, you check in, you just show them that, and use it as many times as you like. Another question. Can you share the breakdown of the pricing and the hotel valuation? Absolutely. If you would like to get on a call with me, a one-on-one call, and that would be the easiest way. I can walk you through why we think this is a fantastic opportunity. We have all the information, but it's a lot of information for you to review. I can walk you through it. Or if you like, I can drop my email, and I can, or I can send it to you by email as well. But to summarize, we believe it's a fantastic opportunity because we're getting it way below replacement costs. So this is a hotel, the Aloft, which was built in 2009. It's got 141 rooms. It did 4.2 million dollars last year in revenue. And we know that there's a lot of potential. It is already generating a very healthy revenue, and daily room revenue, etc., and occupancy. And we believe just through active management and effective management, we can deliver higher returns. So I can definitely send you that information. And the other thing worth mentioning is that we're acquiring this hotel at a 2.5x revenue multiple. For all the hotel experts out there, that's considered a fantastic return. Okay. Okay, I don't see any other questions. I want to be respectful of everybody's time. It is 7:30 p.m., 7:29 p.m., and we're 1 minute shy. So I will conclude the webinar. Thank you so much for joining. And if you like to get on a call with me, I'm going to drop my direct calendar in the chat, and I'll also say it out. It's discovery.qilacapital.com, Qila capital.com, discovery.qilacapital.com. And that takes you directly to my calendar, and you can schedule a call with me, and we can get into the weeds of the conversation and any questions you may have. Thank you so much for joining, and I appreciate it. And I will be hosting these webinars more frequently. I hope to see you at our next webinar, which is going to be taking place on Saturday. So thank you very much, and have a lovely evening. Bye-bye.